Well, welcome to the Student Loan Consolidation Affiliate Training Program, sponsored by the Credit Repair Summit and Scoring.com. Thank you again for your interest in becoming an affiliate. And if you already are, it's a great opportunity to get a refresher course in the process, how it works, and why you should be involved in the program. The real key to this is not why it works and how it works. It is that it does work. The government has in place processes and programs available to almost every consumer. We'll get into a few exclusions in a little bit during our presentation. But the real key to this is finding customers that have government student loans and conveying to them that for no charge whatsoever, that they too can figure out, just like these other consumers did, if they're able to save money or enough money by consolidating their student loans. Okay, that's the key, is to get them on the line and go through a process that only takes a few minutes to determine just how much they will save. And we've got savings ranging, the most right now is almost $2,000 a month, right? So really big savings. And in some instances, some consumers go from a payment that they're not making, thus they're in default, to not owing a payment at all and not being in default and not even being reported as being late. Okay, so just think about the power of that, and of course the opportunity to earn up to $200 per file. The current price for this program is $600 per file, paid in this manner, $200 upon completion of the paperwork, $200 in 30 days or less, and another $200 within 45 to 60 days. The commission is paid as the revenue is collected at a rate of 33%. If you've not signed up yet to be an affiliate, go to this link, the studentloanrecoveryplan.com/affiliate, or ask the person that has invited you to this presentation for the proper affiliate code to sign up for. So I want to go through the sign-up process. Literally, you use that link, you would find this landing page. It's just a landing page. It doesn't give you a lot of information about the program, but it does tell you the key, okay? Make money helping your clients consolidate their government student loans. Forgiveness plans are available, okay? So once you complete this short application, you'll be taken to this long application and complete all this information that you see here, okay? And this is the bottom of that page. And when you do, you're going to get this email from us, and we manually approve all applicants. So it either will get notified, we get notified right away, but if we're available to do this right away, you'll get the next email but right away, but nonetheless, you will receive the next email when we approve you as an affiliate. And this is what it will look like. You will log in by clicking the affiliate login. You will use, of course, your email address and your password to access the system, okay? Now, this is the back end of the affiliate program. So again, you'd use the credentials in that email, and it shows you two or three things. The first thing is that this is the affiliate code that you will use to either sign up your customers or have them sign up. So that would be why, that's where you find that link under the promotion section. Okay, well, actually it's on the home page. Okay, and in the promotion section you'll find some banners that if you connect that affiliate code to this banner, you can post it, and those that are clicking on your banner would go down your affiliate path, and we would know that it's your sale. And in the event that the customer did sign up, you would earn 33% of what we collect. Now, in the back end, there's an additional area called Quick Stats, and it shows you the raw and unique clicks, okay, impressions, and the sales, okay. Now, it has an area here for commissions, but due to the limitations in this system and seemingly every system, we're not going to track commissions here. You will be given an additional login credentials for the back end of our website. Once you have your first deals in place, you'll be given access to that, so that You can track your commissions there, okay? This is the link that the consumer would, this is the landing page that the consumer would find themselves on if they use your link, okay? And of course, up here at the top, it would have that long affiliate link here at the top so that we would know that customer belongs to you. The consumer completes this page. They are then taken to the second page where they're asked to schedule an appointment in the event that they can't call right now. And of course, in the event that we're not available right now. So those are the ways that we set up appointments. Now, we're obviously only asking for a little bit of information. And the reason that we're only asking for that and we finish it online is to reduce any identity theft that might occur with an affiliate that we don't know, okay? Now, this is the back end of our debt consolidation software. And this is one particular consumer. And as you can see, our system is able to pull down all of the loans and identify what category they're in. And of course, then it shows us all of the loans, and it shows us if they're in default or the status of those loans. Now, another view of this. So this particular consumer has about $75,000 in debt. Another view of the same, the rest of the back end. Now, in this particular consumer situation, and I will show you this in just a minute, but various programs have date ranges and limitations. And in one of the loans that the consolidation program that this particular consumer chose excluded or did not allow her to have the lowest consolidation payment possible because some of the loans were before October of 2007. And those loans, and thus this borrower, then is excluded from some programs. And again, a lot of detail there, and that's why we're going to get into this first and the details second, because I want you to be comfortable in the fact that our system identifies all of the loans and all of the programs that the consumer qualifies for, so you don't have to become an expert in understanding all this. All you need to do is say, would you like to determine if you can lower your student loan payments? It's free to find out. Let them use your link, sign them up, get on an appointment. We'll be happy to let you be on the appointment with the consumer, of course, if the consumer agrees to that. And in so doing, you would learn a part of the back end that you don't know about right now. But let's not get bogged down in what program somebody qualifies for, because it would be a monumental effort on your part to really train yourself, okay? Now, in this instance, these are all of the different loans that this consumer qualifies for, and it indicates the P&I or the lifetime cost of those loans, right? Now, this particular consumer was able to choose income-based repayment, and due to the fact that this particular consumer is a teacher, she qualifies for public service forgiveness, program that not everybody qualifies for. So in this instance, she qualifies for, now that she's set up on this program, making, let me go back and look at the number, $229 payments, 420 payments. So that's a total of $27,480. Remember, she's got $75,000 worth of debt. Okay, so she's going to save $47,269 plus interest. Now, obviously, this could adjust. Or what would make it adjust? Well, we'll get into the details of the way that the government quantifies what we call discretionary income. Okay, and that's not the right word for it. It is qualifying income. Let me leave it at that. So if and again, we'll get into the details in just a few minutes, but the way they measure that is that they take the consumer's income, adjusted gross income, compare it to the poverty level in that area that consumer lives in, and then you get the income level that they use here to compute how much your payment will be, okay? So in the event that the family size of that applicant changes over 120 months, and in the event that the income goes up or down over the 120 months, it would affect the payments, okay? But it wouldn't affect the fact that in 120 up those payments. So after they make 120 payments that they may have to qualify for or adjust every year even, right? If their income goes up or down, people move in or out of their household, then that payment will adjust. Again, a lot of details, but I want to just give you enough to give you an idea of how this works, okay? Now, in this slide, you'll see how we're communicating with the consumer. These are the notes in the file. We're always able to give you this information. We don't give you access to our system, but we'll be happy to, answer any questions for you. Okay? So, in this instance, this particular consumer was qualified for the income-based repayment plan. So, in order to make our process run smoothly, and of course, the customer then, has a better experience, and you have a better and happier customer, if they're going to use the income-based repayment plan, then we require that they send in their proof of income before we submit the file, because otherwise we're chasing paperwork and of course it slips through the cracks. So we don't do it that way. We require that proof of income up front. Now let me just stop and give you a little point here. If they work 8 odd jobs and have 8 1099s, it's more complicated than if they've got a payroll check. Okay. So imagine that, and you'll understand how easy or complex the proof of income might be in order to verify that indeed that is how much money they make. Okay. Now again, this particular client qualified for a forbearance between the time they made application and the time that the loan is approved for consolidation. So not everybody will qualify for forbearance, and the reason is because if they've used their forbearances already, then they don't qualify. But in many instances, we're able to put the consumer into forbearance, which means that they don't have to make another payment until the new consolidation loan goes into effect. Okay. Let me give you a word of warning. Never tell a consumer that they don't have to make payments on anything, right? Don't take on that responsibility. Let us communicate facts only to the consumer based on what they really do qualify for, okay? Very important. So the consumer decides based on these options. Let me go back to this slide. So we would give them these options and give them all the facts about it, and they'd understand it, and they would understand that on an income-based repayment plan, if that's what they went with, then they're going to have to make 300 payments of $229, and their lifetime cost is $163,000. Well, that's a lot of money, okay? But it is what it is. They borrowed it. I can't help that, and you can't either. Now, I wanted to mention the IDR for new borrowers and pay-as-you-earn programs, which obviously have a lower lifetime cost here. But the consumer didn't qualify for that because she had loans and she was a borrower. That's the key. She was a borrower before October 2007, and thus she doesn't qualify for all of the plans. She only qualified for a few, and that's why she didn't get the lowest payment. But if she did qualify for the IDR, which is income-based repayment for new borrowers, then she would have had 240 payments of $153 for a total of $74,000, okay? But she didn't qualify for that. And if she had qualified for that, and if she is a teacher, then she would only have to make 120 payments of that payment amount, and the remainder would be forgiven. Okay, so there's a lot of intricacies here, and again, that's why we want to talk about how you're best to sell the program before we get into all the details of the programs. So the consumer decides what option is right for them. They decide if they don't want to move forward, they don't. In many instances, the customer is saving dramatic amounts of money. In some instances, they're not. And of course, in those instances, they don't qualify, right? Or they would qualify, but they may say, well, it's not enough of a return on my investment to spend $600. I'd rather, I'm only going to save $20 a month. So that's a decision. Okay, just like refinancing a house. So again, if you've not become an affiliate yet, go to thestudentloanrecoveryplan.com/affiliate, or ask the person that invited you to this webinar recording for their affiliate code. Want to make sure you get to the right person that has referred to it. Well, we're going to do some free training now to go through a lot of the intricacies of this program. We've got about 150 slides, but we're only going to show about 50 because the others is just too much detail. Okay, so in certain circumstances, your loans may be forgiven, canceled, or even discharged. Okay, so there's 8 types of forgiveness, cancellation, and discharge programs. So let's get right into the meat of this. It is possible, unlikely, but possible, that a consumer would qualify to have their loans discharged in bankruptcy. Well, how would they do that? Well, they would have had to be making payments for 5 years, and it'd be determined that there's no way that and their situation is long term, and they're not ever going to be able to make these payments for whatever that defined reason might be. But if they've not been making payments for 5 years, they don't qualify. So you just can't not pay your bill and then go into bankruptcy. Public service loan forgiveness. So based on the type of jobs that you're in, nurse, teacher, fireman, police officer, work for various certain nonprofits, and your loans started after 2007, then there's a forgiveness program there for you for those loans. Okay, so military personnel, teachers, nurses. So, how many teachers have student loan debt? Well, a lot of them, right? How many nurses have student loan debt? A lot of them. How many child care providers have student loan debt? A lot of them. I know a lady that's got, I believe it was $250,000 worth of student loan debt as a psychiatrist, I believe it was, or some sort of counselor like that. And she works at a catering company making $13 an hour. And thus, her income was so low that we were able to reduce her payments to 0, and she's not in default, and she's on time with her payments. Now, just imagine the power of that and how many people may qualify for that. Now, teacher loan forgiveness. If you're a teacher and also a new borrower and have been teaching full-time in the right kind of environment, low-income secondary school, then and you've been doing it for 5 years, there's a partial forgiveness that's available up to $17,500 of some of your loans, okay? Now, there's a false certification student eligibility. I was actually watching the news yesterday about this, and there are these private schools in which the student got government loans, and there's definitely some fraud there. So we're determining how best to approach that type of customer. We really don't have a good read on that at this juncture, but we'll be working on it. In the event that there was an unpaid refund, the student went to school and met the criteria to leave school, and the loan was not refunded and thus lowered the debt, then that's a possible discharge as well. Permanent disability is another dischargeable item, and death discharge as well, and false certification of student eligibility. Again, a good example of this is at these private schools, but depending on the type of loan you have and when that loan was taken out, you may be eligible to cancel part or your entire loan if you have served in one of these capacities. Teacher, volunteer at the Peace Corps, member of the Armed Services, if you're serving in hostile areas, nurse, medical technician, not a doctor, law enforcement and corrections officers, Head Start worker, child and family services, professional provider of early intervention services. So a big basket of potential customers. Again, there's 40 million consumers that's got student loans, so there's obviously millions of people in each of these categories. So where do you get started? So the best case scenario, as I said earlier, is that you could have a payment as low as 0 and not be late on your payments, okay? So if your discretionary income, that was the word I was looking for earlier, discretionary income is 0, your payment can be 0 as well, okay? Loan consolidation allows you to pay off the outstanding combined balances for one or more of your student loans to create a new single loan with a fixed interest payment. So if you're a consumer that's got, as in many instances, 20 to 100 or 300, I've even heard of $600,000 and $700,000 in student loans, okay, government student loans, you qualify to determine, well, first of all, you qualify for a repayment program that you've got to select, okay, or you can just leave it like it is, either way. But it rolls all of the loans into one loan, and even if the loan's in default, you've had multiple late payments, this closes out that loan, marks it as paid in full, 0 balance, and as well as all of the other loans that you're going to consolidate, and rolls it into one new loan. Certainly more easily managed than as many as I have seen people with 40 and 50 loans. Again, a defaulted student loan may be included in a consolidation program after you've made arrangements with the education department. Now, let's get into this. This is really a little inaccurate. A loan in default means that you have not made a payment in 270 days, okay? But it doesn't mean that it's has graduated to the point that you move from defaulted to garnishment. Once you move to garnishment, it takes 9 monthly payments to rehab the loan and to get it qualified for where you can consolidate. So if you're being garnished, if you're a part-time student or more in school, and if your loans have been, in some instances, if you've already consolidated, again, based on a real specific inquiry that we have to get from the Department of Education, you may or may not qualify for the consolidation. Again, a lot of detail there. But in many cases, some of the balances can be completely forgiven. So why consolidate? Okay, consolidation sounds like a good idea, but what are the benefits? Well, as I said, the student loans are consolidated in one monthly payment with one lender. The repayment options are tailored to your personal financial situation. There are no minimum or maximum loan amounts, and there are no monthly payments. Now, for all of us old mortgage people out there, I want to go to the next step. There's no DTI. There's no credit score. There's no any qualifying questions whatsoever except proof of income on the IBR programs, income-based repayment programs. Other than that, if you've got government student loans, you qualify for something. And we've just got to check to see if you qualify for something that you want, right? So this is a success story. Guy had $10,000 in student loans, were in default, weren't paying them, and payments were $225 a month. True, based on his income-based repayment plan, we consolidated the $10,000 in loans, and his payment is now $75 a month. Well, it may be $75 a month forever, right? Or ever how many months or ever how many years. But, and that's important to understand, but it really doesn't matter because they owe the money. And if they are in default, that it's harming their credit, and they can't get a home loan. They can't do this. They can't do that. So they've got to do, a responsible person wants to do something about it proactively. So who's eligible? Anyone of legal age, loans of any amount, federal student loans only, and must not be enrolled in school part-time or more. Who's not eligible? Well, students who are still enrolled in school, private loans, loans in garnishment, if your student loans have been already consolidated into a direct consolidation loan, so you can't just do this year after year. And then students loans that are already in rehab, and we've discussed that. So what are the criteria? So it's based on your family size, your adjusted gross income, and the cost of living in your area based on the government poverty guidelines. Now, this is the most interesting thing about this presentation. The way that discretionary income is determined is one of the criteria is family size. But who's in the family, right? Well, not only would it be your children or your spouse, but it would be anybody living with you, related to you or not related to you, that receive half of their support from the student and will need to receive that support through the remainder of the certifying year. Okay, so I'll give you an example. My daughter graduated. I'll go through the scenario later, but she's an individual. She's married, but filing individually and not jointly, because if she files jointly, her husband's income counts as the income towards the adjusted gross income of the family, and thus in her instance, her payments were to be $578 a month. By filing married but individually, her income goes down to her income, and she's got one person in the household. But if the neighbor across the street moved in and was going to live there a year, and she was going to provide them half of their support, then she would now have a bigger family. When she has a child, she would have a bigger family. She has another child, she would have a bigger family. And based on the family size, her payment would go down had her income not gone up, right? So that's the family size. Against your adjusted gross income. Now, most of our customers are wage earners, so it's really easy. The adjusted gross income, they're filing a simple tax return, so effectively it's their payroll check. But it also includes these other items in the event that the consumer has a more complicated income structure. Now, if in that event, if you are filing in that manner, you also get to deduct all of these items. So at that juncture, we would require a tax return to determine your adjusted gross income and not just a pay stub. Okay, I made a comment earlier that if you've got a 1099 from 8 different companies, it's or 1 or 5 companies. As you know, it's way more complicated to determine your adjusted gross income than if you get a paycheck. So take that into account when somebody calls you up and says, well, they want 30 different pay stubs. Well, we got to get it from somewhere, right? Got to understand the adjusted gross income before we submit this paperwork, because if we don't gather all those facts and when we submit the paperwork, they're only going to ask for them 30 days later. The consumer still doesn't have them. You know, we've told the consumer, hey, you qualify for this, when in fact they don't qualify for the income-based repayment plan, even though they may qualify for the consolidation. And they would get a consolidation, but it just wouldn't be at the payment level that their income would give them had we provided the evidence that their income is X, right? So obviously a critical element, but I want to really hone in on that, because that's an area of the business that we sometimes have conflict with the consumer. I can't give you all that information. Well, then I'm sorry, but when you can, let us know, and then we'll be able to go forward, because we can't do anything on an income-based repayment plan without evidence of the adjusted gross income. Now, the third area of the computation is the poverty guidelines. So that is determined. Again, our system picks up all of this information. So based on what state you're in and how many people are in your household, it varies from state to state. So there's another slide here. So if a client makes $25,000 a year and has a family size of 3 and lives in Alabama, okay, the poverty guideline for this family size and income is $20,090 a year. So the way we figure it, and again, I'm just showing you all these details, and I really don't expect you to go into any of this with your customer, and if you do, you're probably not going to be that successful with this program. But the formula is annual income minus 150% of the poverty guideline equals discretionary income. So in this case, $30,135, which is 150% of the $20,090, minus the consumer's income, adjusted gross income of $25,000, means that they are $5,135 below the poverty guideline based on this circumstance, and thus their discretionary income is zero. In that event, their payments would be zero. Okay, see how we got there? So more information, there's a discretionary income calculator that is available at this site. Now, the simple three-step process is that your consumer fills out the landing page, calls us, and goes to about a 5 to 10 minute interview. That's the application. They review the payment plans. I showed you that slide, and then they decide what they want. Okay, at that juncture, we send them electronically all the information, all the contracts that they need to sign, and once they send that back to us, and again, if they're going with an income-based repayment plan, along with the proof of their adjusted gross income, then we submit that to the Department of Education or to their servicer. Now, I want to warn you about something. The government has changed the process of the FAFSA PIN number in May of 2015. It is illegal for you or for me to access the government website, even with the permission of the borrower, to gain their new ID in the event that they've not gotten it yet. So we won't do that, and we vigorously recommend that you don't as well. So during our process, we're going to send the consumer this link so that they can get this new ID, so that then we can move forward during our application if we have to, during our interview. And in the event that they don't have it in the interview, we just stop and get it for them, help them get it, retrieve it, and until they do, we can't move forward. Okay, so we'll work with your consumer on that. So during the acceptance, if you decide to proceed with one of the repayment plans, you'll sign and return the application electronically, and it usually takes 45 to 90 days, depending on the number of loans that the consumer has. They're going to receive an acceptance letter from their servicer in 30 days. And we're going to be on the phone with them, making sure that the paperwork that they received matches what they've agreed to, and so that there's no, we don't want your customer to fall through the cracks, and we want to process this as quickly as possible for everybody's sake. Now, there's 5 different repayment plans, and there are 5 primary student loan that are available. 2 are based totally on the student loan debt only. The other 3 are based on income and family size. So we're going to go through the different plans and a few scenarios in order to give you this basic knowledge. So let's get started. The standard repayment plan. The minimum payment offered under this plan is $50 a month for a term from 10 to 30 years. To qualify, the student's got to have at least, to qualify for the 30-year term, the student's got to have at least $60,000 in debt. Okay. Well, we recently consolidated a consumer's debt that had $300,000 in student loan debt, and his payment went down from $3,000 a month to $1,028. Okay. Now, granted, it's for 30 years, and the repayment, the lifetime cost of that is extraordinary. But this gentleman knew that when he took out the loan. Okay. And based on his income of $340,000, there is no income-based plan for him, nor is there a forgiveness plan because he's a financial advisor, but he qualified for the 30-year plan. The standard extended plan. In order to qualify for this, you must have at least $30,000 in debt, and you must be a new borrower after October 7, 1998. The graduated repayment plan is a plan with a fixed interest rate and lower payments at the beginning, but the payments increase over the length of the loan. Okay, the current rate of increase is 17% every 2 years for this plan, and loans cannot be in default, okay? Well, there's some of the other plans, the loans can be in default, and we can consolidate loans that are in default. Now, what qualifies as a loan in default? You haven't made a payment over 270 payments, and according to the student loan website, when we pull down the loans, it shows you're in default. So automatically, you don't qualify for this graduated repayment plan because you've got loans in default. Income-based repayment is based on income and family size. We talked about that, with the maximum monthly payment of 15% of the discretionary income. Now, let me contrast that, okay? You got a borrower, it goes into default, and then goes into garnishment. Well, we can't help that customer for 9 months, okay? But after 9 months of being garnished and paying the payment, then they do qualify for the income repayment plans, okay? Now, let me give you an idea of garnishment, give you an example. One of a lady that I know intimately had $2,500 a month in income. We got notice because we managed the payroll for that particular company, that we got notice of a garnishment from the government, okay? That garnishment goes into effect, and your employer must transmit 25% of your income to the government to repay these loans, okay? Well, we were able to stop the loans going into garnishment because she reacted, or actually we called her up and said, hey, your loans are going into garnishment, and we can stop that if you come in right now and go through this process. She did. And based on her income and her family size and the fact she lives here in Alabama, the payment went from what was going to be $500 a month to zero, okay? Now, imagine the power of that in any family whatsoever. If a lady's not making her student loan payments monthly, it's because she doesn't have enough money, and she certainly can't make $500 payments. All right, so the income repayment plan is calculated. That's the difference between the adjusted gross income and 150%. We've talked about that in detail. I wanted to show you again on the slide. Now, there's also a partial financial hardship. It's decided by looking at the payment amounts of the program. If the IBR is lower than the standard fixed payment amount, then you do have a partial financial hardship. Again, a lot of details to get through. We do it automatically. All right, loans in default are eligible for this program, but not loans that have gone into garnishment, okay? With the income-based repayment plan, your payments change as your income and family size changes. Since this plan can be extended for up to 25 years, you will have lower monthly payments when compared to other loans, right? You'll also have a higher lifetime cost the longer you amortize the loan payments. But if you can't afford, in this instance, the guy had $3,000 or income repayment plan. Let me give you that for example of the lady that was going to get garnished. If you can't afford the payments, then you're going to go into the financial hardship, and in many instances, it's reduced to zero. Okay? The income contingent is based on the adjusted gross income as well as family size. Again, another nuance of the income-based repayment. Again, it can go out to 25 years, and then after 25 years with this plan, the balance is forgiven. So what would you want to do if you had a lot of student loan debt? Well, you'd want the payment as low as possible and for it to be forgiven after 25 years. Now, take into account that you can prepay these loans at any time, even after they've been consolidated. So if you want to get out of debt faster, well, there's certainly a way to do that. But let's get your payments set up on the lowest amount that is required. And then if you're able to make double payments or triple payments or just another $10 a month, they'll be happy to take that, and it will lower your lifetime cost. So another nuance is this is based on 20% of your discretionary income. And again, compared to 25, right, under the garnishment. Unlike the other plans, default loans are eligible, loans in default. As with the income-based repayment plan, the payment for this loan changes as your income changes. So every year, they're going to be asked to provide proof of their income and proof of their family size. And as a result, their payment will change every time that happens on an annual basis. So the pay-as-you-earn repayment is based on the maximum monthly payments equaling no more than 10% of your discretionary income. But you've got to be a borrower you must be a new borrower as of October 1st, 2007. So if you were a borrower, not loans, but a borrower before this date, then you don't qualify for this program. Pay-as-you-earn, further, the monthly payments will fluctuate. We talked about that again. And this particular plan can be set up for 20 years versus 25. Now, this example here that I gave you earlier, based on income, and let me tell you the rest of the story here. My daughter, this is my daughter. She goes to University of Mississippi. I think it cost $250,000. It seemed like, right? And she came back and wanted to go to graduate school. And I said, fine, but I'm not paying for it unless you graduate with a 4.0 average. Okay, and she did. Actually, she graduated with more than 4.0, and then 2 honor societies. Now, the next week after she graduated, she received notification from Nelnet that her payments of $1,000 a month would start the next month. As a responsible person, many people aren't, right? She contacted them and said, I don't have a job yet. No problem. Put you in the forbearance. Let us know when you get a job. Well, 2 months later, she got a job for over $40,000 a year as a teacher, and she called them back. Okay, they said, well, now you, based on are you married? Yes. How much does your husband make? What is your combined adjusted gross income? Great. Your payment will now be $578. End of story. Didn't tell her about the 120 payments. After 120 payments, that the rest of the debt could be forgiven if she qualified, worked at the right place, didn't ask her anything, right? So she calls our call center and goes through the process. Of course, all this is planned out. And we suggest, well, let's check to see if you file married, but individually, how much your payment would be then. Well, based on her income and her family size, the payment would only be $178. Now, if she didn't have the income-based if she wasn't a teacher, and let's just say she worked for me at my office, which my office certainly doesn't qualify as a place where individuals would be given forgiveness, and she made the exact same amount of money that she makes as a teacher, she would qualify based on her income for the $178 payments, and she would have to pay them until she paid off the $89,000 in debt plus interest. Okay, but if after 25 years or after 20 years, based on the specific program that she qualified for, the remainder of that debt could be forgiven. At the same time, she could accelerate the payments and pay off the debt and get rid of it. At the same time, if her income goes up, her payment's going to go up. If her income goes down, her payments are going to go down. If she has a child, her family size increases and the payment's going to go down. If she increases her family size even more, and I'll use the example again, the neighbor across the street, not related to her at all, moves in with her, and my daughter provides half the support needed for that neighbor across the street that's now a part of her family size. Her family size would increase and her payment would go down. Okay, so those are a lot of nuances, but those are all the factors that go into determining this information. Another gentleman, and we talked about that, saved $2,000 a month. Okay, big numbers. This is more information about my daughter. So I want to remind you that while knowing all of this is great, it only takes 5 minutes for your consumer to complete an application, and then we do all of this for you and for them, and you earn up to $200 a file, which is 33%, and that number's there. It's incorrect. It says 30, but it's 33% of the net collected amount that we collect. Now, let's talk about net collected amount. If we collect $200, you're due 33% of it. Okay, we collect $600, you're due 33% of it, which will be $200. Okay, if that consumer charges back, then we're going to call back that the commissions on the one that charged back are that refunded. So that's what we mean by net collected revenue or net collected amount. It only takes a few minutes for the application to take place. For some reason, this slide's here 3 times. I apologize for that. So if you've not signed up yet, go to the studentloanrecoveryplan.com/affiliate or get the affiliate link of the person that invited you to this meeting. We'll get you signed up. We go through a process we described initially. We'll approve you as an affiliate. You'll get an email with all your credentials. With that, you can log in, and if you'll go back to the first of this video, you'll see all the back end of our system and how to log in and how to track your clicks, your impressions, and your sales. After you become an affiliate, we'll introduce you to the back end of the studentloanrecoveryplan.com /admin, where you'll log in and you will be able to check your commissions, okay? So I really do appreciate your interest in helping consumers further their financial progress. And if consolidating is good for them, then it's a great idea, a great plan for them, really changes their finances and really gives you an opportunity to help more people and, of course, earn more money while doing that. Well, thank you again for your attention. If you have any questions, please just go to the website and give us a call. Have a great day. I wish you well.